Welcome, business owners. This is Edward with nonaccountant.com. We already know about our balance sheet and we've learned about our income statement. Guys, today we're going to be introduced to our third report. This is equally as important as our other two. This is the cash flow statement. This is going to be amazing. We're going to learn about how all three of these statements interact with each other, talk to each other, and they paint a picture and show us what's going on in our business. They help us follow the flow of money. Okay, so guys, let's go ahead and get ready. We will be using QuickBooks today, and we're using a desktop version. It's going to allow us to see all three of our financial statements simultaneously. It's going to be powerful. And don't forget, this information you're going to learn today, you can use it in any business that you see fit to start in the future. So guys, let's jump into it. Okay, so we're in QuickBooks and we have our three financial statements. We have our balance sheet here, cash flow statement in the middle, and then our profit and loss on the end, on the right side. So let's do a quick refresher. Our balance sheet is simply, it shows us our net worth of the business. Cash flow statement is going to actually show us the flow of cash in our business. And the profit and loss, also known as the income statement, is going to show us our profit or our earnings. And what we're going to do, first we have everything up, all three up together. What we're going to do is look at them one by one, because as we know, accounting is not, it's not one of the simplest things, but guys, we're going to break it down. We're going to make it easy, and let's look at our balance sheet. We're going to make this bigger so we'll see everything. Now, balance sheet is simply assets minus liabilities to give us our equity or net worth. And in QuickBooks, what you do, you have the power. You can actually drill down, you can expand or collapse. So as you see, this is not really appealing and pleasing to the eye. So what we're going to do is basically wrap these accounts up. So under cash account, we have a checkings. So we're just going to pull that in. And what we can do is pull this in further. And now we have our current assets. What we can do, since we understand that our current asset here is just cash, we're going to actually zip this up so it's all on one line. It makes it easier to see. Okay, so our liabilities, we have a note payable. That's a long-term liability. And we're going to zip that one up. And now we have our equity accounts right here. So we have assets, which is cash in this example. We have our liabilities, and then we have our equity. So we're going to look at this current asset. We have $300 of cash in our account. We have a liability of $100, so debt on our books that is due. And now equity. Equity is made up of several things. It's increased by you as the owner putting your own money, because sometimes owners, they may deposit their own personal money into a business to increase the cash. And net income, or this is the amount of profit that comes over to the balance sheet. So the balance sheet is very important. It is basically the cash flow statement and also the income statement. They link up to the balance sheet, and we'll look into that further. But let's see. So equity wise, we have, and look how we can break this down. This 300, we have $100 coming from a long-term loan. So that's debt. That makes up that amount. We have $100 we have put in personally, and we have $100 from a sale or from income from our business. So I want you to understand this thing is that there's basically three ways you can generate cash. So if we had this 100, this 100, and this 100, we'll get this 300. And if you just look at your total liabilities, 100, total equity is 200, that comes up to 300. So the three ways you can generate cash: you can either do it from customers, that's revenue. You can obtain cash from a bank through like a loan or debt. And then the third way is the owner, yourself, putting money into your business. So these three things will increase the cash in your business. So of course you want more of it to come from what? You want it to come from net income or from the sale or your main operations, because think about it. If you have money coming in from a loan, that's really not revenue, and then you're going to have to pay interest on that. So that's an added expense. if you have money coming in from capital, you putting personal money in, those are two signs that, okay, over a steady amount of time, if loans are increasing and the money you put in personally, if it's increasing over time, that is a sign that the business is not generating enough revenue, because it should be paying for itself. You get what I'm saying? So this is our balance sheet. So we're gonna zoom out. We're gonna zoom into let's look at our profit and loss, because the statement of cash flow pretty much is a bridge between both of these. So we're gonna zoom into our profit and loss, also called an income statement. So we just had a sale of $100. So we have no expenses, so we're profitable. We have net income or profit of 100, because again, we have sales of 100. We don't have any expenses in this example to deduct from those sales. So we're going to end up with a net profit of 100. Okay. So if we go back here, you see our net income is 100. This is the flow. This is how this net income flows and talks to our balance sheet. Do you remember in one of our last examples or last mini courses, we learned that net income or profits, they increase equity. Losses, so if you have a loss on your books, that is basically having more expenses than income. That's going to reduce the equity or the value or the net worth of your company. So the profits go over, they flow over to our equity, and they increase it. And then sometimes QuickBooks, they will call this net income. Sometimes in accounting, they will use the term retained earnings, and that is just the same as the profit flowing over to your balance sheet. Okay, so we're going to look at our cash flow statement. Cash flow statement is very beautiful, very powerful statement, because what it does, it shows us the actual movement of cash, and it breaks down everything, because in accounting, is, if you're looking at it on the accrual basis, you're tracking non-cash related transactions and transactions that directly impact cash. So for example, let's say if I invoice a customer, and that's going to increase my revenue, but it's going to increase what is called a accounts receivable, or just an invoice, because if I was not paid cash, I don't book the cash on my books until I get paid. But I want to book the sale. You book the sale when it's completed, and I want to book the accounts receivable, which is just an invoice, and that is basically just money that is owed to you. And guys, in another lesson, we'll dig deeper into it. But let's look at our cash flow statement. Cash flow there's three ways you can generate cash in a business. You can do it through operations, you can do it through financing, and you can do it through investing. So in this example, we don't have any investing activities. We only have operating right here, and we have financing activities. So when you think about business, where would you want to generate most of your cash? Would you want to do it through financing? Would you want to do it through investing or operations? And you don't really have to know. It's kind of intuitive. You don't have to know what is involved in investing and financing activities. But if you're in business, you probably said you would want to generate most of your cash through your core operations or through operating activities. And these are basically just, like I said, just your core activities, the core ways that you generate cash or sales. So operating activities, we take our net income. So we generated $100 in cash from net income. Now, financing activities, this is very important, because financing is money coming from your other two sources. Remember, it's coming from like a bank through a loan, long-term loan, or through the owner investing personal money into the business. So those are considered ways you finance, and I'm doing the quotation marks with my hands, because you got money from a bank, and then you're becoming a bank by loaning money to your company. You are financing your business. So we put in we got a loan of $100. This represents $100 in cash, and then we invested $100 in cash. So that's $200 from our financing. We got $100 from our operating right here. So the $100 plus the $200 we're going to get an increase of $300 of cash. So we're going to go back in. We're going to look at these statements. So basically, I like to start with the balance sheet to see what are our current assets, or what is our cash. What is it looking like? What is the current balance? Because your balance sheet is basically where you stand right now. It's the results. It's the product of the results that come from your income statement. So right now we have $300 worth of cash. Now we want to drill in deeper. We want to see, okay, how is that cash generated? And we can look on our balance sheet. Okay, we have a note, so we know if we have a note, we got cash for that note. So we received cash, and we'll have to pay that note at a later date. Also, we're looking at our equity. We see that we put in $100, and that 100 came from actual sales, which is good because we want to increase that part of our equity. So again, equity is a two-part thing in this example. We want more of it over time to be increased. We want more of it to come from the net income and not from capital, our personal money per se. Now, if we look at our balance sheet, cash flow statement, we will see we have our $100 from sales right here and the net income. So the sales is going to flow down to net income because we don't have any expenses. That's going to flow back over here. And our notes payable, we got cash for financing. So these two areas make up financing: long-term debt and equity. So guys, it's like a big puzzle, and it's beautiful. It truly is. I love accounting. I love financial statements. I love reading them because they tell us so much. And guys, I want you to review this video, this mini class, and just kind of, if something was clear or unclear to you, just kind of watch it over again, watch it slowly, and reach out to me. If you have any questions, any comments about this video, how it can be better, because I know we went over a lot of information in a short amount of time. I do want to say this, guys, and get comfortable with looking at your financial statements at the minimum monthly, and as you build up that tolerance and that knowledge level, when you look at these things, it won't be like gibberish. You'll see how everything kind of flows together. And these were very simplistic examples of how all three of these statements talk to each other. And of course, you'll have bigger numbers and more accounts, but I want to kind of ease you into learning how to read these statements, because there's so much more we can read. Oh, and one thing I forgot, I want to show you a quick tip. If you're looking at financial statements, how to quickly see if everything is jiving right. So we're going to look at our key numbers right here, our cash. So this is how our balance sheet and our cash flow statement are linked together. Your ending cash amount, so cash at the end of the period right here, should always be the same as your cash balance right here. And this is our cash account. We just have it zipped up. But these two should always be the same. And also that net income amount that flows over here, these will be the same as well. So this is how your cash flow statement talks to your balance sheet, talks to your actual cash balance, and also your net income right here. That's going to talk to your balance sheet as well. So that's how these two reports, your statement of cash flows and your profit and loss, that's how they talk to your balance sheet. And the reason I have this in the middle, because as we look at more examples, we'll see that the statement of cash flows, it does one thing. It really reconciles your net income right here to your cash balance. And because a lot of people may think that just because your cash is a certain amount, all that is made up of net income. And as we saw in this example, we generated cash from a loan, and we generated cash from putting money in our sales. So there's three ways how money came into our company. So we have to track that flow of cash accurately. So we have to really know how our cash is being generated. And again, we want the majority coming from operations, which will be coming from our profit and loss statement or sales or profit. So if you have any questions about this video, if you have any comments how it can be better, let me know. And you guys just sit tight. We're going to have more videos come up, and we're going to just get deeper into this. and deeper without getting too complex. You know, so I don't want to scare you off, because I know accounting, financial statements, it can be scary and is scary to a lot of individuals, but not here at nonaccountant.com. So you guys stay tuned, and I will see you guys later. Thanks for watching.